Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any financial or investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hello, I'm your host, Dale Schaefer, and here's another great episode starting now.
Let's go.
And this is episode 26 of the Financial Purpose Podcast. Today, I'm joined by a very special guest and friend of mine, Andrew Kish with Luminate Home Loans. Andrew, welcome to the Financial Purpose Podcast.
Thanks, Dale. It's great to be here. Appreciate it.
Absolutely. Great to have you here. And so, Andrew, I'm going to just do a little brief introduction for you, and then you can kind of fill in the gaps along the way. So, Andrew is a reverse mortgage specialist at Luminate Home Loans. Luminate, brand new. This is you represent the only branch of Luminate in the state of Arizona. Is that correct?
That's correct.
Excellent. And you have a bit of a diverse background. I know we met probably about I'd say almost 2 years ago now. We've known each other. And so you've done a lot of work, a lot of industry experience across the world for some of the big publicly traded companies that we all know, if I said the names, but I won't because this episode is not about them. It's about Andrew. And you've got a lot of P&L management experience. You've been everywhere from Europe to Asia to the United States, grew up in the Midwest. You've been married for 9 years to your wife, Ashley. You've got 2 rambunctious but healthy boys. And you're both in real estate. You've got a lot of experience being a real estate investor yourself. And now we're talking about reverse mortgages. So, Andrew, is there anything that I missed or that you'd like to tell more about?
That was a great intro. I appreciate that, Dale. And it has been quite the transition, spending 23 plus years in corporate America, like you say, living and working globally. Being in high-level leadership roles. It was a big shift about 2 years ago, jumping into the mortgage industry, but it was someplace that I've always had a passion. You mentioned about my wife, Ashley, has her real estate license. Well, actually, she got her real estate license. I got my mortgage license at the same time. We had previously, been acquiring rental properties, remodeling rental properties, and managing those. So we'd rent them out and manage them ourselves. And so we always had a passion in the space. And so when I left my last corporate role, I saw an opportunity to make a shift in my career. With the passion that we both had in real estate, we thought it was a great opportunity for her to get her license, me to get my mortgage license. And then I very quickly gravitated towards the reverse mortgage space, primarily based on my business background. The reverse mortgage product is misunderstood. I'd say by and large, people misunderstand, what it's about. There's a lot of negative connotation, some bad history with it, which, we kind of go into, as we're chatting here. But, I saw there an opportunity. Throughout my career, I've done a lot of education, both to, my teams, to clients. I've always, even from a sales perspective, when I was in the corporate world, it was always a consultative sales process where I was educating, B2B clients. So I saw a great opportunity here to, leverage that experience and help educate, business partners, professional partners like yourself, as well as, clients on, what is the reverse mortgage product really all about, and how to use it as a financial tool, which is what it actually is. And so again, having the business background that I have, it's been a great fit for being able to kind of take that business acumen, that business mindset, and look at the reverse mortgage product and how to apply it as a tool in the toolkit for a broader financial management, wealth management strategy planning, type activity. And so, when I work with partners and clients, I want to take a role where I really try to approach a broader understanding of the financial plan, the strategy that's in place, and ensure that, I can educate and then, help determine if the reverse mortgage is going to be, a complementary or a supportive tool to that strategy, and either help to enhance it or enable it, in various ways. And so that's where I've seen good success, in the couple of years now that I've been in the industry, is really kind of being that partner, that advisor, to try to help, educate and determine where the product fits, and help people, understand that, a lot of negative connotation, negative perceptions or misconceptions about it, aren't really accurate.
Yeah, and that approach, Andrew, is why I think we have had a good relationship going forward, because I know it's, reverse mortgages is definitely one of it might be among the most hated financial products that are available. I as a financial planner, I don't understand that, because I like the reverse mortgage in the right applications, just like any other financial instrument. In the right applications, it can be a very helpful tool. So maybe tell the listeners and a little bit here, Andrew, why does the market, why do advisors, why do clients, why does everybody hate the reverse mortgage so much?
It's a great question. I think, from the folks I've talked to, and a lot of financial advisors, that I've spoken to in the last couple of years, the traditional mindset has always been that the reverse mortgage is really a product of last resort, right? That, kind of leave the home set aside as an asset that's not going to be touched. It's not going to be part of any financial management plan. The focus is always on the other investments in the portfolio and other, income streams, and that the house is kind of the contingency plan, right? And that's, I think, that's maybe the traditional mindset that a lot of folks have had of how to approach it. And what I've done is I've found over the years several articles and white papers that are, dispelling that notion, and suggesting that, you actually get more benefit out of the reverse mortgage product by using it proactively, using it earlier in the process, not waiting until all the other assets are depleted to then tap into it. What it actually does is it allows the borrower to take the burden off those other investments. If not be forced to have to liquidate certain investments and assets in a down market, for example, where those assets are depressed. So if you had the reverse mortgage in place, you'd be able to pull on that and leave the rest of your portfolio alone, and give it time to recover. Things like that. It's also one of those assets, one of the only assets, your home, where you're still gaining appreciation even while you're using the equity, right? So, if you have stocks or mutual funds or ETFs or other things in your portfolio, the only way to really get the cash out of those investments to utilize it for other things is to liquidate them. And then you're going to lose any future upside. Whereas your home as an asset is going to continue to appreciate based on market value, not based on the amount of equity that's in the home. So you can leverage that equity, utilize that equity, still continue to get the upside appreciation that asset's going to gain just through normal market appreciation. And there's also flexibility in how you use the product, which we can get into some of that detail, but it's not a one-time, pull all the funds out and that's that. Actually, the most common vehicle for utilizing a reverse mortgage is a credit line, which really gives absolute flexibility and control to the borrower, where they can not only draw, but they can pay that line back down again. They don't have to, but they have the option to. And so, there's benefits to utilizing the product in that way, because you're avoiding some interest cost, by paying that balance back down again. You're avoiding that future interest cost. You're now giving yourself availability of that credit line again in the future. And there's another feature that not everybody's aware of is when you have a reverse credit line, that credit line actually grows over time. Now, depending on the type of product you're in, it grows at different rates. But but that credit line does increase over time, and so that again, by paying it back down, having availability of that balance will then grow, and so there's that benefit as well. But I think some of the other common myths that people have and why they're looked at so negatively is that people think they're selling the property to the lender, right? So they feel like, or the perception that's out there is I'm giving up ownership of the property, or I could be kicked out of the property, or if I use up all my equity, I'm not gonna be able to stay living in the home, etc. The main thing that people need to understand about a reverse mortgage is that it's a mortgage. So it's a mortgage just like a forward mortgage. You still retain ownership of the home. You just have a lien against the property, in form of a mortgage, just like you would on a forward mortgage. When you leave the home, same thing happens. That loan needs to be satisfied. Just like if you had a forward mortgage and you were leaving the home, that loan would need to be paid off. It can be paid off in a number of ways. It can be paid off via cash, via refinancing into a new loan, or by selling the property and then just paying the loan off. So it's really no different in that regard. You still have your obligations that you have with a forward mortgage. You can't get behind on property taxes and insurance, HOA dues. If you do, then you potentially get a lien against your property and you go into a foreclosure process. That's what happens with a forward mortgage. Same thing can happen with a reverse. I think the issue is that it may be perceived to happen more often with a reverse, primarily because most people, when they have a forward mortgage, they have the property tax, the insurance in escrow, and it's paid by the lender, right? So it's part of your monthly payment. Then that gets paid by the lender when it's due, and so it's out of sight, out of mind. When you have a reverse mortgage, since you're not making a monthly payment anymore, now it's the homeowner's responsibility to pay that property tax and pay that insurance when it's due. And so that's probably the main issue that we've seen is if the homeowners aren't educated well and reminded that that's their responsibility, then they could potentially be delinquent on making those payments, and that's where then they could get into a default position. So that's one of the things that me personally, I really drive that point home with clients and make sure that they're aware. I even have certain clients that I'll set reminders and follow up with them when I know property taxes are due for the first year, just to make sure that they don't trip up and they don't have that issue. Now there is a safeguard in place that's been built in by the regulators, where everyone who's going to get a reverse mortgage has to go through mandated counseling. And that's actually one of the key things that is focused on in that mandated counseling is the homeowner's responsibility to pay the property tax, pay the insurance, et cetera, right? So they're hearing it. So even if they don't hear it from the loan officer that they're working with, they're going to get it in their counseling session. It's going to be in the documents. And again, I know a lot of people don't like once they finally sign and they're done, with those documents, they're probably not going back and looking at them. But it's reiterated over and over and over again throughout the process, just to make sure that people are fully aware.
And I was going to ask about that counseling requirement, because the reverse mortgage, and you said a couple of things in there that were points I was going to hit on. So they are unique, and I've sat through your presentation, so I've seen this. I've had other education. I've read books on reverse mortgages, all of that. But a lot of people who might be hearing this, no clue, right? It even sounds weird. It sounds possibly too good to be true. What do you mean I get to have a mortgage, but I don't make a payment? And they're unique because you do have the counseling requirement. There's an age requirement. There's, the fact that you don't get a payment, or you don't have to make a payment, but your credit credit line can continue to grow over time at, some compounding rate, depending on where things are at that point. And then also there's some tax advantages to using the money in a reverse mortgage as a credit line versus a stock portfolio or something like that. So I just hit probably 4 or 5 different things, but can you start maybe by talking about why the reverse mortgages are unique, and particularly around the age requirement, which also then predicates the requirement of the counseling, right?
Yep, absolutely. So yeah, the reverse mortgage was originally designed for, retirees, people that are entering retirement on a fixed income. And what they've done is, you spent your entire life building home equity, right? You've had a mortgage. You probably didn't pay cash for your house initially. You probably had a mortgage at some point in time, and you've worked diligently your whole life to either pay that off completely or mostly. And so you have a lot of equity built up in your home, but now you're in retirement and you're on fixed income, and it's tough to make ends meet, right? And so the whole purpose of the product is to then, think about your home as kind of like the biggest savings account you're ever going to have, right? You're paying into it, your working life, building all that equity up. And then, now you're in retirement, you're able to now access that equity and start pulling it back out. And so it's intended for retirees. There's 2 different main products, types of products. So there's the HECM product, which stands for Home Equity Conversion Mortgage.
I'm glad you said that, 'cause I thought you were just swearing at me when you said heck. I was like, what did I do? Oh, okay.
Or clear my throat.
Yeah, right.
Yeah, so yeah, the HECM is the FHA product. That is the product that's backed by HUD, and has some more stringent requirements around it. For example, the age requirement is age 62. At least one borrower needs to be age 62. Okay, I say that because you could have a married couple where one spouse is 62, the other spouse is 60 or 55 or even 25. I had somebody ask me at one of my seminars, can you do a reverse mortgage if you have a significantly younger spouse? And the answer is yes, you can. But there are some effects that has, and I'll touch on that in a moment. But so age 62 for at least one borrower. If the other borrower is not age qualified, then they would become what we call a non-borrowing spouse. And the key to that designation is that they get all the same protections as the borrower. So if a reverse mortgage is put in place and the borrower ends up passing, that non-borrowing spouse, still is able to continue to live in the home without needing to make a mortgage payment. Can live in the home as long as they want. Their only obligation is to keep up with those property expenses, taxes, insurance, HOA fees, and maintain the home. Don't let the home go into major disrepair, right?
Sure.
So as long as they do those things, they're guaranteed to be able to stay in that home as long as the borrower, all right? The only disadvantage to the non-borrowing spouse is that if it is a credit line, they don't have the ability to draw the credit line. So once the borrower passes, then they would not have the ability to access additional funds if there was funds available. Which is why one of the strategies that I would typically employ with clients is if you do have somebody that's age qualified, somebody that's not, and they want to get into the reverse and it makes sense to do it at this time, what we would do is set up a strategy to get them in. But then once the non-borrowing spouse becomes age qualified, 62, we would want to refi them so that that spouse now becomes a co-borrower. So that if anything should happen to the other spouse, they then still have access to the credit line. Now, again, there could be other situations where we don't have a credit line. Maybe they're just getting into the reverse mortgage to eliminate their forward mortgage payments. They had a pretty substantial mortgage balance still. We just wanted to eliminate that. In that case, probably doesn't make sense to refi them. Or maybe we're using the reverse mortgage to purchase a property, which I can go into detail on how that works. Yeah. But if they do that, then that's typically a one-time lump sum activity. There's not going to be additional equity, to access down the road. So again, probably don't need to think about a refi in that situation either. But if we're talking about having a substantial amount of equity on a credit line that we want to have access to, then we would recommend that non-borrowing spouse, so that we do a refi and make that non-borrowing spouse a co-borrower at the right time. Okay. So those are kind of the things about the HECM. And then the second type of product that's out there, we call it proprietary. You could also think about it as jumbo. People are probably more familiar in the forward mortgage world with the term jumbo. The only reason I say that is because one of the limitations on the HECM is not only the age 62, but it's also the what we call the max claim amount, which you can equate to the property value. So for this year, the max claim amount is $1,089,300. So that's basically the cap that we put on the home value. If your home value is less than that, no problem. Whatever it appraises at is what we're going to use. It appraises at 900,000, then it's 900,000. If your home appraises at 1.5 million, well, then we're capped out at that 1,089,300 if we want to use the HECM. There are these proprietary products that actually go up to a home value of 4 million, which is why we kind of say, in a sense, they're kind of like the jumbo product, right? So because they go to a higher home value. But there are other differences. So for example, the age requirement, the HECM is 62, the proprietary is 55, right? So here again, one borrower needs to be at least 55 to get into the proprietary. You would say, okay, well then why isn't everybody using that product? Age 55 to get into it, goes up to 4 million, seems like it's a much better product than the HECM. In those couple aspects, you could argue yes. But there are other factors. So the HECM is going to give you the best rates. So you're definitely going to get a better rate with the HECM than you will with the proprietary, which is again consistent in the forward mortgage world with your conventional loan versus the jumbo loans. We know that jumbos always come in at a higher rate. So it's similar there. And then some of the other features like the credit line growth rate I mentioned earlier. So with the HECM, if you have a credit line and let's say we close your loan at 6.5% as your starting rate. Well, not only does your loan balance accrue interest costs at 6.5%, your available credit line is also growing at 6.5%. Okay, so that's where there's big benefit to the HECM is you're getting a pretty significant credit line growth rate. It actually equals whatever your mortgage balance rate is. Whereas the proprietary products are going to have a growth rate as well, but they're much lower. Typically, it's going to be about 1.5%. So it doesn't matter if your loan rate is at 6.5 or 8.5 or 10%, you're still only going to get 1.5% growth on your credit line. Also, the HECM, the credit line grows for life. So as long as you're in the loan, 15, 20, 30 years, if you're not touching that credit line, it's going to keep growing. And you can draw it for life. As long as there's available credit line there, you've got access to pull that money out as long as you're in the home. With the proprietary product, you only have a 10-year draw period and it only grows for 7 years. It's capped out at 7.
Interesting.
Yeah. And so typically, again, and that's why, not to get too into, different scenarios, but it's really going to depend on, the situation. I'd say 80+% of the reverse mortgages that are being originated are going to be the HECM because it's basically a product to get into for life. The proprietary has its purpose. And again, that's for higher home value. So again, like I was saying earlier, maybe if you're using it to do a purchase, maybe if you're just trying to completely eliminate a forward mortgage, and you're just going to do it lump sum and be done with it. And maybe again, it's just the way the numbers are going to work. You need that higher max claim amount to be able to make it work. Maybe that proprietary works for you, or you're not old enough yet. So you're not 62, you're 60. or, in your late 50s, so there is a place for it. But typically, if we are going to look at the proprietary product, the idea is that it's a bridge until the borrower becomes eligible for the HECM. And at some point, you would want to convert them over, typically.
Okay.
But again, there's scenarios where that's not always the case, but that's typically the case.
Yeah, and I have seen in my own experience, I've seen a couple of things. First thing I've seen is the reverse mortgage used or the HECM used to pay off a traditional forward mortgage, and then that switches that client to not having the mortgage payment requirements, and then they can access the credit line. And for a lot of people, especially fixed income, that's where it works incredibly well for that purpose. Yep. The other thing that I've seen, maybe this would fall under the misconception umbrella, is people just saying, well, but if I do this reverse mortgage, and then when I die, my kids, they're going to have to sell the house because it's going to have this big loan against it, and they've made all these memories here, and they're going to want to keep the house. And in my experience, the kids don't want the house, they want the money, and they would rather have the money from your investment portfolio than they would from trying to deal with having to sell the house and try to split equity and deal with all that mess. So am I off base, or is that also true to your experience?
Yeah, no, you're right on. And that's been the transition, I think, and maybe let's say our grandparents, or, maybe even our parents' generation. It's, the idea of the family home, that the kids, may want to move into, that's gone, right? I mean, that was the case maybe back in the 50s, 60s, 70s. But, as you indicated, most times, 9 times out of 10 now, the beneficiaries are just going to sell the home. They're treating it like an asset, right? And so, that's what it is. It's an asset. They're going to treat it that way. If they do want to retain it, yes, they've got options, right? So they can go get their own mortgage. If they've got the cash, they just pay off the loan balance and they keep the home. If they want to go obtain their own financing through a forward mortgage, they could do that. If they're age qualified, they could go out and get their own reverse mortgage on the property, right? And if they want to move into it, right? So that's the requirement. I didn't touch on it earlier, but that's one of the other key requirements of any of the reverse products is it has to be your primary residence, right? So you have to be residing there.
I was just going to ask, because for everything that you and I just said culturally, where I see that slightly different is in situations where it's pardon me, like a second home, a vacation home, a lake cottage, something like that. Right. Those situations, the inheritors will generally hold on to those kinds of homes because they have more value to them. Right? Yeah. The second home, or a place to go spend a week vacation or something like that. So I was going to ask if that meant that these had to be only owner-occupied properties, or could you have a reverse mortgage on a second home or a vacation home or something like that?
So yes. So the answer is it has to be an owner-occupied. You have to put the loan on an owner-occupied property. Now, that doesn't mean that you can't use the proceeds from a reverse mortgage to acquire a second home or an investment property, right? Uh-huh. So if you have your primary residence paid off, you have a lot of equity in there, and you want to go pull some of that equity out and go purchase that second home or that investment property, then you can do that. Just like you could go do a cash out refi with a forward mortgage, you can do the same thing with the reverse, but again, the benefit is you don't have to then make payments. So you can pull that equity out of the one property to then acquire the second or third or whatever additional property. But yes, the loan itself has to be on the primary residence. Okay,
yeah, that's helpful. So we talked about the age requirement and the counseling and some of the ins and outs, I guess, slightly the ins and outs of how the reverse mortgages work and how the credit lines grow. And so I think at this point, I'm curious, who is typically an ideal borrower in a reverse mortgage scenario? Who should consider a reverse mortgage, and maybe even touch on who it's not ideal for?
Yeah, great question. So I think you've actually touched on a couple ideas, right? The traditional mindset is, somebody's going into retirement and, they're on fixed income, and, they're just trying to minimize their expenses. And so they still have a forward mortgage, and that's a big expense. And so they're trying to eliminate that. So a reverse, is a great way to do that. We pay off that forward mortgage and now eliminate the forward mortgage payment so that it immediately benefits cash flow.
Mhm.
Through the process, we could also pay off other debts, car loans, credit card debt, things like that. So you can do a debt consolidation. Is another, it could be wrapped in with that, or it could be kind of secondary via credit line. So there's a couple different ways that you can approach that. Even after doing those things, even after eliminating the forward mortgage, consolidating other debt, you might still have a situation where, the fixed income, that the borrower's on just isn't quite enough. They still have a gap, in their monthly cash flow, and, they need to fill that gap somehow. So that's another way that the reverse mortgage can be utilized, is we can set up either a term or a 10-year payment, term being, set monthly payments for a period of time, 5 years, 10 years, what have you. And I'll stop there and say, here's an exact scenario you can think about, right? So you have somebody who's newly retired, hasn't actually started withdrawing Social Security yet. Maybe, so they're 62. Let's say that they have a strategy where their financial advisor has worked with them and said, look, if you can delay taking Social Security until 65, right, here's what your increase in benefits going to be, right? We can help bridge that gap via the reverse mortgage, where you could get set monthly payments for a 3-year period that would be enough to, sustain the lifestyle, and then start taking Social Security payments at 65.
Yeah.
For example, right? So there's a scenario or a strategy there to use it. So you can do that. You can do a combination. You can have those set monthly payments, of 500,000, whatever the borrower needs, and then have the remainder balance sitting on the credit line, so that when you have those one-off things that happen, major medical expense, major car repair, home repair, other emergencies that may arise, they have funds they can just tap into that credit line and pull whatever they need. Maybe $5,000, $20,000, whatever it is, to cover that one-off item. They can do that, still while they're getting their monthly payments, right? So those are, I'd say those are kind of the primary uses. It's really that cash flow and addressing that. But some other things to think about is, peace of mind. We talked earlier about the borrower, the non-borrowing spouse, and what happens when somebody passes away, right? So there's a lot of cases where, if that primary income earning spouse would pass away, maybe he has some medical issues, maybe he's significantly older, so there's some factors there that would suggest that spouse may pass, or will likely pass, prior to the remaining spouse. It's peace of mind, setting up that remaining spouse so that they know, and they can have confidence that they could stay in the home. Because maybe, once, again, just with Social Security, for example, we know that when the primary income earner passes, the remaining spouse, will get, a portion of, that Social Security benefit, but not all of it, right? So, you had two people living together on a fixed income, one passes, their monthly expenses don't drop by a significant amount just because that one person's no longer there, yet their Social Security benefit could, or will, right? Likely. So, there's a situation where then that remaining spouse may not be able to afford to stay in the home, right? If they have a forward mortgage payment that is unaffordable and other things. So, part of it is just peace of mind of knowing that surviving spouse, will be able to stay in the home, won't have the expense issue, the cash flow issue, might have additional funds available if there's, credit line and other equity they can tap into. So it's really just setting that person up. Okay. Unfortunately, divorce situations, and we do see that the data is showing that there's an increase now of older divorces. They're calling them gray divorce, silver divorce. Yeah. So so we're seeing that as well. And again, we have a situation where I think traditionally, one of the spouses would want to stay in the home, but they can't afford to, right? And so here's another option where the reverse mortgage might allow one of the spouses to remain in that home, and be able to afford, not have to worry about a forward mortgage payment, also have equity that they could tap into. And so there's a solution there that would ease, that transition, for that couple that, as they're going through that difficult, situation, right?
Yeah.
So that's another, one that people aren't really thinking of. Semi-retirement, early retirement. I mean, we're finding people nowadays that are kind of getting in that late 50s, kind of age range where they don't want to have to work full time, 40, 50-hour work weeks anymore, but they're not ready to completely retire either. So they want some flexibility in kind of a pre-retirement stage. And I'll give a quick case study. So I had a client who came to me. It was exactly in that situation. He owned his own business, doing tile contracting. He was in his late 50s, and it was like, look, I don't want to work full time. I'm not ready to retire yet. I want to kind of pick and choose the jobs I do. And I want to be able to take time off and work on my own house and do that. So how can we make this work? So we set him up in a proprietary product credit line, which gives him the ability now to take a few months off, not have to work, not have to rely on income coming in. He can draw his credit line for living expenses. He can draw additional funds to buy materials to work on his house. And then he can do a few jobs and get some good income. And once he gets the income from those jobs, he can turn around and pay his credit line right back down again. And now he's got that credit line still available to him in the future. And so the idea is that he was 57 when we got him into that loan. He's got till 67 where he's got access to that credit line.
Yeah.
But at 62, he becomes eligible for the HECM. So at any point between 62 and 67, we could refi him over into the HECM, and now he's got that credit line available to him for life. But it's just given him now complete flexibility and financial freedom to, kind of be in that pre-retirement phase, really pick and choose the jobs he wants to do, not has to do, right? And so great solution for him.
I love that. I love that creativity, and sorry to cut you off, but
Yep.
as a financial planner, I love the ability to be able to break the linear way that people think about money. Because we just think about, okay, I can only use this account for this type of thing, and I can only use my home for this kind of thing. And when you're able to say, no, we have the flexibility when the market's not behaving properly, we can switch where the money's coming from. We can switch it from portfolio to home equity, conversion. We can use the reverse mortgage to supplement income. We can turn that off and go back to. It just gives people a lot of flexibility, and something like that for somebody who's approaching retirement, they can have some flexibility in their planning. I love it.
Yeah, absolutely. Trying to think. So then there's another traditional mindset that right in line with what you were just talking about, which is kind of the traditional thinking of, okay, when we pass, we're gonna leave our inheritance to our beneficiaries, right? And everybody wants to be able to leave that big inheritance behind and know that their family's taken care of. And yeah, that might give you some peace and satisfaction, on your deathbed that you're doing that. But the reality is, your beneficiaries don't see the benefits of that until you're gone, right? And so you don't actually get to witness it. You don't get to, get that real satisfaction or gratification out of, seeing what they do with that inheritance. And, I'd say in most cases, that inheritance probably isn't happening at a point in time where it's necessarily needed by the beneficiaries, right? So, throughout our lives, we go through these major life milestones of, you know, going off to college, and then, getting married and buying your first house, and, then you have kids and your kids are going to college. And so there's all these points in time throughout, our lives where you have these major milestones that have a pretty big financial component to them, right? And, those are the points where you most need, the additional, funds. And so, a different mindset here is that you can, rather than wait till you're gone to start to transfer all of your inheritance to your beneficiaries, you could actually start transferring that inheritance during those major life milestones, right? So if you set up your reverse mortgage credit line when your kids or your grandkids are, going off to college, buying their first house, getting married, doing all these things, you could then have the ability to help them financially get going, get into, through their major financial life milestones, and one of the biggest benefits of it is you're doing it tax free, because when you're pulling funds out of your reverse mortgage, it's a mortgage, so it's a loan, you're not getting taxed on that. So you essentially can start transferring, now there are some restrictions, and we don't have to go into all the details, and people should talk to their CPAs about gifting, and all that. But there is the ability to pull funds out and transfer those funds over, a much longer period of time, so that the beneficiaries are getting the money when they need it most. And, the additional benefit is you're actually here to enjoy it, right? You get to get the gratification, see the excitement, the gratitude that they have, when you're able to help them out with that, at that point in their life. So there's the soft benefits of it, and then there's the financial benefits of being able to do that as well. And like you touched on earlier is, typically what happens at the very end, again, when that house gets sold and there's a ton of equity in there, not only do you have, bigger tax implications, but then it's all the beneficiaries trying to figure out how to divide it up, and, all of that versus, if you're able to parse it out, over, a much longer period of time when they need it, then there might be less of a burden, at the end, to worry about. So it's a completely different philosophy, I guess, if you will, on it.
Yeah, it makes total sense. And again, estate planning really puts a lot of this in its proper place at its proper time. But I'll tell you, I also really like the concept of people being able to use their wealth, because for a lot of retirees, a good chunk of their net worth is sitting in the walls and the dirt and the foundation and the carpet, and it's in the house. It's not in their investment accounts. And so, the biggest fear that a lot of people have heading into retirement is am I going to have enough? Am I going to run out of money? And what will I do if that happens? Right? Because by the time I run out of money, I'm going to be too old to work, or my healthcare is going to be more expensive. And what about Medicare and all these other things that they have to worry about? So having the flexibility to use all of the assets available to them, being equity in retirement, kind of helps put that concern about, will I run out of money at bay? Because I know retirees who, they have to think about, can I go see my grandkids right now because the airlines are so expensive and rental cars are expensive, everything's just more expensive. So can we go see our grandkids, or do we need to not go see them this summer? Now, that's a really, really tough decision to make, especially when you're at the point in your life where you've worked, and so now you should be able to enjoy, but you're having to put some limits on that. And if you have this other resource available, it's helpful in how that money gets spent.
Absolutely. Yep.
Okay.
And
Well,
then on the flip side,
go ahead.
you said, who's it for, who's it not for? So I think, we talked, who's it for, not for, obviously, if you're not age qualified, right? So that's an easy one. If you're looking to purchase second home investment property with the loan itself, then obviously you can't do that. But what I'd say that the other one, the key one is time. It's not a short-term product. If you believe that the home that you're in, that you're going to put this loan on, you're only going to be in for a few years to 5 years, then don't do a reverse, right? Because it does cost more up front. And so that's one of the other issues that we didn't touch on earlier, but
Right.
one of the reasons that it has a negative perception is because it has that upfront cost. But what people have to think about is there's a reason that there's higher upfront cost, right? With a traditional mortgage, you're paying the lender's giving you money, and then they're getting paid back over 15, 25, 30 years. They're getting a consistent cash flow coming back in. When you do a reverse, the lender's giving you a bunch of money, and then they don't see anything back for 10, 15, 20, 30. I mean, for who knows how long, right? So yes, there are upfront costs that go with it. And that's why I say if you're only going to be in the property short term, the upfront costs are probably not going to make it make sense. So I would say, you really want to be pretty certain that this is a property that you're going to be in for at least 10 years, or more, if you're going to do it. Now, again, things can happen at least 10 years, or if you pass, that's a different story. But if you think that there's a chance you're going to move out of that property, sooner, then 8 to 10 years, I would say, is probably about the minimum you want to be in that property for. Oh yeah, and then the amount of equity.
That's where I was just going to ask that question. Yes, good.
Right. If you don't have at least 55 to 60% equity in the home, then it's not a product that, I mean, we could do one, but what would happen is you have to come to the table then, just like with another mortgage, you'd have to come with funds to make up the difference at closing. So if you only have 40% equity in your home and we're trying to put a reverse on it, you're going to have to come up with that other 15, 20% equity, to be able to close the gap, to be able to get the reverse mortgage done. So you're looking at a big out-of-pocket expense up front to do that. It's probably not going to make sense. I mean, for whatever our goals are to use the reverse, I would say it's probably going to be contradictory to coming out of pocket with that much cash. So that's really a key thing to consider. Now, it used to be in the earlier days, and this is where again people have a little bit of a misunderstanding, because you used to be able to pull like 80-90% equity out of your home with a reverse. And that's where there were some issues early on with people getting upside down in equity, and then they weren't making their, and that again wasn't necessarily the issue why they might have been, kicked out of their home or foreclosed on. It was probably, not only that they were upside down, but then they weren't paying their taxes and insurance and other things like that, right? They've revamped the program now, so you've got more robust protections in place for the borrowers, but also they've drastically reduced the amount of equity that you can get, right? Basically, the amount of equity, there's a couple factors. We look at the home value, it's based off of that. The older you are, the more equity you can pull out, but the higher the rate, the less equity you can pull out. So they're kind of working, so what we've seen here in the last year with rates going up like they have, it used to be if you had 50% equity in your home, we could probably make a reverse work for you where you could at least pay off your existing mortgage and not have to come out of pocket to be able to do that. Now, we're closer to 55 to 60% equity, because we've reduced the amount of, the rates have reduced the amount of equity that you can access. But again, that's where that credit line growth feature comes in and kind of offsets that. Is, yeah, there's less equity that you can access now, but if you set up that credit line and just let it sit there and grow, then you can be getting 6-7% growth on that year on year. And so, yeah, maybe you don't need it now, but you're setting it up for, again, protecting the surviving spouse, in a situation where that might occur, just protecting against any kind of emergency, major expense that might come up. but your plan isn't really to be using the funds. You're not going to be taking the monthly disbursements. You're not going to be, pulling a lot of it out on a regular basis. You still set it up and just let it grow over time. And then, but you still have the peace of mind that the surviving spouse is going to be taken care of, that you've got funds available for emergencies, things like that.
Yeah.
So that's another consideration.
Okay. Well, this has been I don't even know if this is the tip of the iceberg for this topic, right? Just like anything that's really interesting, and there's enough complexity and that kind of thing. But as for people who are listening, I mean, if you're if you're in your 30s or 40s, this is definitely something that you can talk to your parents about, and you can send them this episode or any number of resources on reverse mortgages and get them to somebody like Andrew who can be helpful in discussing those options. But if you're in that age group for a reverse mortgage, and this directly applies to you, and Andrew, what's maybe something for somebody hearing this conversation that you would want them to take away?
Again, I just mainly is not to view the reverse as like, the boogeyman, that it's been made out to be historically.
Yeah.
Definitely not to think about it as, in fact, it's funny, I had a call with another financial advisor a couple of weeks ago, intro call with her. And the first thing she said to me was, yeah, I've always thought about reverse mortgages as like a product of last resort. And I said, that's hilarious. Give me a second. Let me share my screen with you. And I showed her my presentation deck. And the title slide of my presentation deck is reverse mortgages, not just the last resort, right? And so I think that's kind of the key takeaway for people that, they either have a negative perception or have, some of these, myths about reverses that they see them in a negative light. I think don't think that, it's a tool, it's a product, it has a place. And then, mainly think that it's not a last resort. There are a lot of different scenarios where you can utilize the product proactively. It can be very complementary to a broader financial plan and strategy to do a lot of different things. Again, one we didn't even touch on earlier, which is using it to purchase. I know we're wrapping up, but again, people don't realize you can use a reverse to purchase. And so when people are downsizing, they think all I've got is the equity from the house I'm selling. So if I have 500,000 in equity, then I want to pay cash, then I can only afford a $500,000 property. Well, no, the reality is with that 500,000 cash, you could really afford about a $900,000 property, because you could use your cash and then reverse the rest and buy that $900,000 property and never have to make a payment on it, right? And so in a way, you could basically get into that property for almost half price, live in it until you die, and you've never made another payment on it.
And you can reuse that $500,000 along the way.
Right.
Yeah, that's amazing. Well, Andrew, tell the listeners how they can get in touch with you if they have more questions about reverse mortgage or even getting a review of their situation. How can they reach
you? Absolutely. So you can reach me at andrew.kish@goluminate.com. It's my email, phone number 602-710-0856. That's my direct number. So if anybody has questions, wants me to run a scenario, has questions and wants to just kind of talk through some of these, myths, misconceptions, different scenarios and case studies of how to use it, I'm always happy, to run through that with anybody that's interested.
Great. And I'll put all of that contact information for you in the show notes. And I would just say for anybody listening, reverse mortgage is definitely another way that people can continue to live out their financial purpose. So if you have questions about that, please get in touch with Andrew. If you want to know how it could fit into your financial planning profile, your health monitoring for financial life, reach out to me. Be happy to help. And in the meantime, until next time, take care. Thanks, Andrew.
Thanks, Dale.
If you enjoyed this episode, be sure to like, subscribe, and share. Learn more about your financial purpose at lifemoveswealth.com.